Well, we're ready to dive into fixed income valuation after our journey through fixed income terminology and all of that. So we'll get to some meatier material here and talk about some valuations and yields and spot rates and semi-annual yields to maturity and all of that. So let's start off with a simple example. If we've got an 8% annual pay bond, this is a bullet bond, pays its face value at maturity, and here's our cash flows per $100 of par value. Well, 8% is our coupon rate, and the coupon's paid annually, so per $100 of par or face value of the bond, we're going to receive $8 at the end of the first year, $8 at the end of the second year, and the third year, we get the $100 back plus that last interest payment. So in the third period, we get back $108. So how are we going to calculate the value of the price of a bond? Well, let's look at this 3-year 8% annual coupon bond and say, well, the market discount rate, that's the required rate of return. What a bond buyer requires as a return is 12%. So here we show that calculation. N is 3. We have 3 payments of 8. So that's our little annuity piece. And then the future value, we're going to set this at 100. That's at the end of the third period. So we're doing all this in end mode on your calculator. I over Y, well, we have an annual discount rate, an annual payment. So we just use that annual discount rate of 12% and then calculate the present value of the bond. We see here, because the market required rate of return is higher than the coupon rate on the bond trades at a discount. In this case, a discount of just about 10% from its face value. And here's what that calculation that your calculator is doing looks like. We've got 3 payments that come, one at time 1, one at time 2, end of the second year, one at time 3. So we discount this payment for 3 periods, this one for 2 periods, this one for 1 period, add them all up. So what we've done is we've used that market discount rate to take the present value of those 3 payments. Very straightforward, nothing we didn't cover well in quant. So how do we calculate a market discount rate? Well, we can go back and forth, and you should understand that for a particular bond and a fixed rate bond, we've got a series of payments. And in that last slide, we had the discount rate and we solved for the price. Well, if we had the price, we could also turn around and solve for the discount rate. So we can quote these bonds either way. We can say, well, these bonds are for sale for 90.393, or we can say they're for sale at a yield of 12%. Same thing. If you know one, you can calculate the other. Just because the other terms of the bond, we know the payments, we know when they come, we know how much they are, and so we can either do it with the discount rate or the present value, one-to-one relationship. And we'll refer to this yield as the yield to maturity, and we'll discuss that more and more as we go through fixed income securities. But for the calculator, we've got N equals 3, payment equals 8, same thing we had before, future value 100. So there's your payments. And then we say, well, the present value of those payments is this, and then we can just use the time value of money keys, solve for the discount rate that makes the present value of those cash flows equal to 90.393. And that turns out here to be 12%. Not surprising after our last slide, but it turns out to be 12%. So this we're going to call the yield to maturity. And here we say, the curriculum says this assumes that you hold the bond to maturity, that all payments are made, the bond doesn't default and pays on time, and the coupon payments are reinvested at the yield to maturity. That's what we assume for this calculation. I think another way to say it is a bond buyer would actually make an internal rate of return on this transaction of 12% if the bond were held to maturity, all payments were made on time, and that bond buyer was able to reinvest coupon payments at the yield to maturity, the current yield to maturity in the marketplace. So now let's look at a semi-annual pay bond. In Europe, they have a lot of annual pay bonds, as I understand it. Haven't traded over there much. But in the U.S., bonds very often make 2 payments a year. So we say their periodicity is 2. So now when we quote this coupon rate, we really have to tie that together with the periodicity. How many times a year does it pay? So we could say, well, we've got an 8% annual pay bond, or we've got an 8% semi-annual pay bond. Well, with a semi-annual pay bond, that 8%, we're going to pay $40 twice a year on a $1,000 face value bond. So it's still 8%, but it's made in 2 payments, and we know that's better. It's better to get money earlier. So in this case, N is going to equal 2 times the number of years to maturity, and we should see that. There we go. N is going to be 6 semi-annual periods. Our discount rate we're going to use, since the payments now come semi-annually, we need a semi-annual effective discount rate, and that's going to be half of 12. So that's our discount rate is going to be 6% for our semi-annual payments. The future value is par. Here we're doing it with $1,000 instead of $100, and it doesn't change anything. So here's what it looks like. Here's the math of it. Here's the maturity payment. The final payment is that last 6 months interest. Here we're back doing it in percent. So we're getting 104% of face value at the final payment date, 6 periods out, 6 semi-annual periods out. In the meantime, here's all our semi-annual coupons. And we've just done it the same, 5 periods, 6 periods, 4 periods, 3, 2, 1. So that's the number of 6-month periods. This is the end of year 1. This is the end of year 2. And this is the end of year 3. And so now we just do the present value of all of those. It comes out to 90.165 here. So still, if we have the yield, but now the yield is 12% on a semi-annual basis, and we translate that to mean, well, 6% every 6 months. Here's the calculator keystrokes on it. As we noted, N equals 6, 6% discount rate. The payments are 4, okay? And the future value is 100, and we compute the present value. So here we've plugged in the yield for a specific bond and found its value in the marketplace as the present value of its promised payments. Now, what about a zero coupon bond? How often do they pay? Well, they only pay once at maturity. Could be a 30-year zero coupon bond. You buy it for $400 or $300 now and get $1,000 30 years from now on a zero coupon bond. But just by convention, we often discount these using semi-annual compounding in yields. And what that does, it allows us to compare the yields on zero coupon bonds to the yields on semi-annual pay bonds. And it's just not a fair comparison unless they make the same sorts of payments. But here with the zero coupon bond, we want to be able to compare it to that. We could do it on an annual basis if we wanted to compare it to the yield on an annual pay bond. But for the most part, but it should be identified what type of yield to maturity we're using. So when we say the yield to maturity on a semi-annual basis is, that means periodicity of 2, that is split between the 2 semi-annual periods. We end up dividing it by 2. So we've got 6 semi-annual periods, no payments. Payments are 0. The future value is face value. Our discount rate is half of that stated yield to maturity because it's stated on a semi-annual basis or with a periodicity of 2, and then calculate the present value. So that's 79.031% of face value. And so now we can compare that to this yield, to the yield on semi-annual pay bonds. And there's the math of it. We just take the single payment at maturity 3 years out and discount it for 6 semi-annual periods at 4%, and that's what your calculator did to come up with that. Okay, some relationships now. When yields go up, prices go down. Now that's for a fixed income security. When you think of a bond, if you could just think of that stream of promised coupon payments and that payment at maturity, that's fixed. That's what you're buying when you buy the bond. Well, what do we want to pay for it? We want to pay the present value of those future payments. That's going to be the value of the bond. So if the yields go up in the marketplace, or simply on this bond, perhaps the credit quality of the issuer deteriorates, then it's going to trade up to a higher required rate of return in the marketplace, a higher yield. Well, discount rates up, present value goes down, so yield up, price goes down. If we say the price has fallen, then the at least promised yield is up, and vice versa. And as we discussed before, if the coupon rate is greater than the yield to maturity, then this bond is going to pay at a premium. Imagine a bond is issued at par when interest rates are 8%. Now interest rates fall to 7%. Well, those promised 8% payments each year are now more valuable, so it trades up above its par value or face value. And just the opposite is true if the coupon rate is lower than the yield to maturity. If it's issued with a coupon rate equal to the yield to maturity, then the bond trades at par. If yield to maturity subsequently goes up, bond price goes down, trades at a discount to its par value. Now, we talk about the convexity of the bond price yield relationship. And we can describe this, and it's easier to draw, and we'll show you that in just a minute or two. But the price increase from a decrease in yield is larger than the price decrease from an increase in yield. That's our convexity relationship. Our maturity effect is that values of bonds with longer maturities are more sensitive to changes in yield to maturity. Now remember, yield to maturity is our discount rate we use to value those bonds. So if we have a 2-year bond, let's say just think of a 2-year annual pay with a yield to maturity at 10%. Well, you've got one term that's discounted at 1.1, 1 plus 10%. You've got one discounted at 1 plus 10%, 1.1 squared. Now imagine a 20-year bond. Well, that maturity payment is now being discounted at 1.1 to the 20th power. And I just say this to help you better understand this maturity effect. So if you've got all these discount factors, 1.1 to the 10th, to the 11th, 12th, 13th, 14th, when you change the yield to maturity, that discount factor with those powers of 13, 14, 15, out to 20 years in our example, they are going to move a whole lot more than just 1.1 or 1.1 squared. So that's what leads to this maturity effect. Small changes in yield to maturity can lead to fairly large changes on a relative basis in the price of longer-term securities. And the bottom line, longer-term maturity values are more sensitive to changes in the yield to maturity than our shorter-term bonds. And the coupon effect, values of bonds with lower coupons are more sensitive to a change in yield to maturity. Well, think of the extreme case of a lower coupon as being a zero coupon. And what's our cash flow pattern with a zero coupon? Well, with a zero coupon, our cash flow is, let's say it's a 20-year zero, okay? We have our face value here 20 years from now. This is time zero. And we've got, for an annual pay bond, the value of this thing is 1,000 over 1 plus the yield to maturity to the 20th power. And since that's 1 plus yield to maturity to the 20th power, That, I'm going to say, is pretty sensitive to changes in this yield to maturity. Now, what happens when we add coupons? Well, when we add coupons at all of these interim dates, say 20 annual coupons, and say it's a 5% bond, so now you've got 50, 50, 50 on out, and this is, of course, 1,050 at maturity now, because you get that last annual interest payment at the end. So the point is now, with more of those cash flows coming closer to the present, as we move cash flows and part of the value of the bond to these earlier payments, well, it's kind of the same argument we made with the maturity effect. The present values of these coupons are less sensitive to changes in the yield to maturity than this single payment out here that we would have with a zero coupon bond. So that's the coupon effect. As we increase the coupon payments, we move more of the value of the bond toward the present, and that means that its value is less sensitive to change, for a given change in yield to maturity than a bond with a lower coupon, the extreme case being a zero coupon bond. So let's look at this price-yield relationship with some numbers here. We're looking at a semi-annual pay 8% 3-year bond. So that's our N equals 6, right? 6 semi-annual periods. Future value, 1,000. That's our maturity value. Our payments are half of 8% of $1,000 each 6 months. That's our $40 payment. So we calculate the present value of this, and let's start with the middle one here. Add 8%. Compute, well, I guess I can't start with the middle one. It's, I sure can. I'll just do that. Okay. So that bond's trading at par. Remember that. If it says a bond, an 8% bond is issued at par, that means that the yield to maturity is 8% on the same basis as the bond is paying. So in this case, semi-annual yield to maturity. Now, as the yield falls to 4%, well, that bond's going to trade at a premium. Market yields fall, that stream of payments, the present value goes up, and here we've got $1,112.03. And at 12%, at a higher market yield to maturity, required rate of return, that bond will trade at a discount. So we may as well illustrate convexity for you here one more time. Let's just take a look at that. We're starting at par and saying, well, what if yields fell 4%? I know it's a big move, but it still illustrates this concept. Okay. So at a 4% yield, what's this difference here? How much did the price go up? The price went up $112 plus. And what is this? Well, this is minus, it's what, $98.35? Minus $98.35. So remember, what did convexity say? Convexity said that bond prices go up more for a given decrease in yield than they go down for a given increase in yield. So that's what we've illustrated here with an actual numerical example, is that it went up by $112 if rates fell 4%. It went down by only $98. So that's our convexity effect. And here's the picture, and the convexity is that this is bowed out. It means it's not a linear relationship, and it's convex toward the origin down here. And so this also illustrates that. Here is the 112, here is the 98.35, and you can see those would be equal if this were a straight line, if that were a linear relationship, but it's not a linear relationship, it's convex toward the origin. So price falls at a decreasing rate as yields increase. That's another way to say it. And this is true for option-free bonds. We'll see that this price-yield relationship can be different for different types of bonds. But if we're just talking about a full coupon, non-callable bullet bond, this is typically the shape we get for the bond's price-yield relationship. What is the constant yield price trajectory? Well, what we're saying here, we buy a bond at a premium or a discount. We're still working with our same example here. So that premium bond with a yield to maturity of 4% is trading at $2,112.03. And so what we've plotted here is the value of that bond as time passes if we hold that yield to maturity constant at 4%. And the one thing to take away from this is because it's curved this way, it's approaching its maturity value at a faster and faster rate. And notice that we have dollars or some sort of currency units on our vertical axis there. And if we bought this bond at a discount, so now our yield to maturity is 12%, it's going to move to its maturity value at maturity, but now it's increasing, and it's increasing at an increasing rate between now and maturity. Now, we're going to use this constant yield price because when we talk about making a capital gain on a bond transaction, let's look at this bond right here. Let's say we bought it right down here, okay, and we sold it for this value after, let's see, we've only got 3 years to maturity, so we better sell it after 2 years. If we sell it at this price right here, even though that's a higher price than we purchased it at, there's still no capital gains because that increase was really interest. Now, if we sold it here, we'd have a capital gain. If we sold it at a price down here, we'd have a capital loss. So we'll see that in an LOS that's coming up, that how do we tell if we have a capital gain or loss when we sell a bond? We aren't going to compare it to the purchase price. We're going to compare it to its constant yield price at the time of sale. And so that's what's being plotted out here. So it does a couple of things. It helps us to understand that concept better, but it also gives us an idea how bonds change relative to the maturity value as time passes. So there are price gains as time passes, even if the yield stays the same when we have a premium or a discount bond. If it's a par bond, of course, it just stays at that value as long as the yield to maturity stays constant at 8%. The bond's price is going to stay constant at its par or maturity or face value. Okay, now we need to talk about spot rates. We've talked about this yield to maturity, and these yield to maturities are kind of a summary measure because we're discounting every payment at the same discount rate, our yield to maturity. So that's really a summary measure. But yield curves are not typically flat. The interest rate on money a year from now is typically different from the interest rate on money to be repaid 2 years from now, and that can be different and almost always is different than the rate for money to be borrowed now and repaid 3 periods from now. So these spot rates, they're kind of like zero coupon bond yields to maturity. They are the market discount rate for a single payment in the future. So when we talked about a 3-year bond with its yield to maturity, especially our semi-annual one, we were discounting 6 different payments at the same rate. Well, this is a more precise way to do it and has other applications which we'll get into. But so these spot rates are for each maturity. So we're going to use Z's to represent these because they are, as I say, zero coupon bond discount rates. Well, any single payment in the future is like a zero coupon bond. You buy it now, it pays this much in the future. So now let's look at some spot rates and see how we can use these to value a bond. It's very straightforward. We're going to take each spot rate and use that to discount the payment that comes at that time in the future. So at a 1-year maturity, we've got an annual rate of 2.5%. Now we've got an annual pay coupon bond. It's a 3% bond. So our cash flows at the end of each of the 3 years are 30, 30, and 1,030. We've got an upward sloping spot rate curve. That is, the 2-year rate's higher than the 1-year rate, and the 3-year rate is higher than the 2-year rate. And so now we're just going to take this, we're going to go 1.035 to the 1, 2, 3. So that's an annual rate. That's why we need to take it to the third power there to get the present value of that. For the $30 payment, we're just going to put in, I'll try and write this a little bigger for you this time, 1.30 squared, and this one 1.025. So that's all there is to it. We're just using each spot rate to discount the payment that comes at that maturity. So this bond has 3 payments at time 1, 2, and 3. We're discounting them at those spot rates specific to each period. And here's what it looks like with much better writing than I put on the last slide. We tried to do these so you can actually read it. And that's it. So we've discounted each of those 3 payments, added up the present values. That's the present value of the bond, and we valued a bond using spot rates. Now, and kind of another topic heard from here, accrued interest. Well, since a bond pays interest periodically, let's say we've got one that pays every 6 months. Well, what happens when you buy it between coupon dates? Well, the seller of the bond has some interest coming. Because the buyer of the bond, in order to be good delivery, the bond must have the full next coupon on it. So even if you bought it 15 days before the next coupon date, as the new owner of the bond, you get that full coupon. Well, in return, the seller of the bond gets compensated for the time since the last coupon date. So that's the accrued but not yet paid interest on the bond. And so we're going to set, when we settle up with the bonds, we're going to have our price, and then we're going to add this accrued interest to it. Now, there's 2 ways to calculate this accrued interest, or at least 2 that are of interest to us. There's the 30-360 method, in which we assume every month has 30 days, and we assume there are 12 months in a year. Well, that's easy to swallow, but that gives us 360 days in a year. Now, we also have the actual, where we use the actual number of days in each month, and we use a 365-day year, unless it's a leap year, I guess. So actual, or 30-360. So let's look at the calculations for a bond that had a coupon paid on May 15th. The trade will settle on August 10th. So how much of the period is that? That's what we want to look at. How much of that interest rate period between coupons has passed? So we're on May 15th, so we get 15 days in May. We've got all of June and all of July, but we assume they are 30-day months. And then settlement is on the 10th of August. So we've got 10 days in August, 30 in June and July, and we're 15 days into May, so that's 85 days. Well, 85 over 360, let's see, I guess we've got an annual coupon here since we're dividing by 360. If we were talking about semi-annual coupons, it'd be the percentage of the semi-annual period, and it would be 85 days over 180 because the next coupon date is coming up sooner. So here, 85 over 360, that portion of the year times the interest paid for the year, 40% per $1,000 of face value, and so the accrued interest on this bond purchase is going to be $9.44 a bond. With actual, well, you've probably caught on to this by now. Okay. We have 16 days in May. Why? Because May has 31 days, and we're going 16 days from the 15th to the 31st. We're using actual now. And 30 days in June, and 31 days in July, and 10 days in August, and so we get 87, and actual, 87 over 365, that's the portion of the year that has passed, so the accrued interest is $9.53. Now, that said, you would think we would look at the bond price and add the accrued interest, and that's what the buyer has to pay. Well, that seems all right, but now you're looking at this and saying, well, hold it. What, am I going to pay a different price if they use actual than if they use 3360? That doesn't seem right. It's the same bond. How does the calculation affect things? Well, as we'll see, it's not quite intuitive, but it's easy enough to understand if I can manage to explain it well. We're actually going to figure out what that bond is worth on the settlement date. And however the accrued interest is calculated, we're going to subtract that from the true value at the invoice date and say, okay, that's the bond price, here's your accrued interest. So if the accrued interest is calculated in a way that the accrued interest is more, then the price of the bond is going to be less. What holds steady is that at settlement, the price you pay for the bond plus the accrued interest must equal the actual value of that bond on the settlement date. I hope that helps. Now, the flat price is the clean price or quoted price, does not include accrued interest. The full price, is sometimes called the invoice price, because that's what you have to pay when you get your invoice on the bond purchase, or sometimes we call it the dirty price, just to differentiate it from the clean or flat price. And that's the flat price plus the accrued interest through settlement. Now, going back to what I said on the last slide, the full price, we figure that out. And then we subtract off the accrued interest, and that must be the flat price. I know that seems a little backwards, and that's why I highlight it here. It's easy to miss that, what could be a crucial point for some questions. Corporate bonds, you can figure they typically use 30 to 360 day method, and government bonds use actual. Now, what is matrix pricing? Well, say we've got a bond and it doesn't trade that often. So we don't really have market price information or market yield to maturity information. Same thing, right? One-to-one relationship. So with matrix pricing, we're going to look at the yields to maturity of some traded bonds of the same credit quality. We've underlined that, and I'll underline it again because that's a crucial part of matrix pricing. We've got to look at bonds at the same credit quality, and we're going to see some yields to maturity. But it's matrix because we're looking at a number of bonds, because we may have a 4-year bond and we don't have good trading information on 4-year bonds. We've got yields on 3 years and 5 years and 6 years or whatever. And so in that case, we use linear interpolation to adjust for differences in maturity. So here's an example. I think this will make it clear enough. We're going to need to estimate the yield to maturity for a non-traded 3-year annual pay bond. It's rated A+ based on the following bonds rated A+. So that's the first thing. Bonds all have the same credit rating, so don't get fooled on that. If they give you some information on bonds with different credit ratings, you can't interpolate using a AA bond and a BBB bond to get an A bond. The interpolation and the matrix just involves maturities here. So now we see some traded bonds out there. We've got a 2-year and 2 5-years. And we are after a 3-year. So before we get into the real details of it, just think of it this way. We have a 2-year maturity, 4.3%. We have a 5-year maturity. Well, we have 2 of those. What are we going to do with those? We're just going to take the average, and we're going to use 5.2% over here. And then, write that a little more clearly for you, sorry. And now, this is a 3-year period. We want a bond here at time 3, so we are 1/3 of the way from 4.3 to 5.2. And so that's where the interpolation comes in. I meant to say 1/3 of the way. And so we'll take the difference between them, 0.9. We'll take 1/3 of that, 0.3, and add it to the 2-year to approximate the market yield to maturity on the 3-year. So now let's see that with some better writing. First step, average those two and get your 5-year yield to maturity. Next off, here's the interpolation. 3 minus 2, that's a 1. 5 minus 2, so there's our 1/3 of the difference of 0.9%, 1/3 of 0.9%. Well, we're 3/10 of a percent from 4.3 on our way to 5.2. And so that's matrix pricing. Those are all the moves. That's all you need to know. Okay, yield to maturity for a semi-annual pay bond. We're back to that. Yield to maturity is 2 times the semi-annual internal rate of return. So we've got the price, and this is all this notation without the numbers. Looks a little more cumbersome, but I think you understand all of it now. We're using, for each semi-annual period, the yield to maturity that is quoted as 2 times the semi-annual discount rate. So that's why we write that in as yield to maturity over 2. The payments, exactly what we've discussed. Coupon payments, final payments, par or face or maturity value plus the value of that final coupon. So now we can look at our 3-year, 5-year 5% semi-annual bond price, 102.8. Well, we've got a 3-year semi-annual pay bond, N equals 6. The payment, 2.5 per $100 of value. Future value, 100. The 2.5 is half of the 5% every 6 months. And calculate the present value. The bond's trading at a premium because we have used a discount rate. We're plugging in the price and getting the yield, and it has to be lower than the coupon rate because the bond's trading at a premium. That's what I was trying to get, is to make some sense out of the bond trading at a premium. Okay. So our yield to maturity is 4%. We double that IRR that we calculate at a price of 102.8. And so that's our yield to maturity on a semi-annual bond basis is 2 times the semi-annual internal rate of return that we can solve for when we plug in price and the promised payments. Okay. Notice that our equivalent annual yield is not the 4%. We actually have to take account of the compounding, right? Just goes back to what we did when we calculated effective annual rates for a stated rate of 8%, stated rate of 4% with semi-annual compounding. There's our effective annual rate. So nothing new there. We're just applying it to our bond and adding it to our bond terminology. Okay, some other types of yield. We talked about yield to maturity on different period basis, different frequencies. The current yield is kind of an historic measure. It's very easy to calculate. We just take the annual coupon payment over the flat price. That is the price without accrued interest. So for an 8% 3-year semi-annual pay bond priced at 90.165% of par, the current yield is just that coupon, 8% over the flat price. And we get a yield of 8.873%. So it's a little higher than 8%. Why? Well, we put in a discount price. We put in a price below par, so we get a current yield a little higher. But the trouble with the current yield is it doesn't take account of the movement of the bond's price or value from the discount, 90% of par, up to par value. So it's just very easy to calculate. It's still calculated, it's still used, but it has some drawbacks. So you notice from the bullet point there, what I just said, it ignores the movement toward par value, and these relationships hopefully are very clear to you now that the current yield has to be less than the yield to maturity for a discount bond. and the current yield is greater than the yield to maturity for a premium bond. And that's because it ignores this movement toward par value. Of course, for a par bond, they're both going to be equal. Now, how do we adjust for this movement toward par value? Well, one way that's been used historically is the simple yield. And I keep saying historically, but please understand, bonds started trading way before financial calculators had been invented. So they had to use tables for the present value. And so some of these calculated yields, even though they have shortcomings, were adopted because they could be calculated given the technology that existed at the time, and then they've just carried into the current time where we could program any kind of a smartwatch to do bond pricing. So the simple yield, they looked at the current yield and said, you know, we got to do something about that movement toward par value, get a little bit better measure here. So with the simple yield, we're going to take the annual coupon and we're going to calculate an annual amortization. And so we take the difference between par value and current value, spread that over the number of years that the bond has until maturity. And so that's what at the top where it says assume straight line amortization of the premium or discount. That just means we can take the premium or discount and divide it by the number of periods until maturity. So for a numerical example, we've got an 8% 3-year semi-annual paid bond priced at 90.165, a very familiar bond to us by now. So what is the discount from face value? The discount from face value is 9.835% of face value, or $9.835 per $100 of face value. Well, it's got 3 years to go, so let's take this 9.835 movement to par value by maturity, divide it by the number of years to maturity, and get an annual amortization of 3.278% of par value. So now our simple yield, this is what we did for the current yield, this is what we did for the current yield, this is how the simple yield differs, that straight line amortization of, in this case, the discount. So now this raises the simple yield, and we get a little closer to the yield to maturity. Now the yield to maturity that we had before was 12%, so now rather than undershooting it with the current yield, we've overshot it a little. And why would that be? Well, with the straight line amortization, remember, as time passes, remember our constant yield price trajectory? We said for a discount bond, its movement toward par value is more rapid as we approach maturity. So by dividing by just 3, we've kind of put too much amortization of the discount in this first year and overstated the yield to maturity a bit by doing that. But certainly, at least now we've done something with the movement toward par value, and the simple yield is certainly an improvement on the current yield. Okay, more about yield conventions. As you've started to understand, there's lots of ways to express yields. There's different periodicity, and different names for yields, and you need a lot of them. Well, here, our yield conventions are either street convention or true yield. This is pretty straightforward. Street convention assumes the payments are made on the scheduled dates. So when we're really calculating bond values, we're talking flat prices. Remember, we need the accrued interest, we need the actual dates, and those payment dates are going to affect our calculations. When we want the true yield, well, over a bond's life, maybe certainly if it's a longer term bond, some of these coupon dates, if they pay on February 15th every year, then that's going to come on a Sunday sometimes. That's going to come on a day on a Saturday. or a holiday when banks aren't open, and that payment is just not going to be made until the next business day. So in order to calculate the true yield, we use the actual payment dates, as opposed to street convention, in which the calculations are made assuming that the payments are made on the scheduled dates. Well, let's pause for a minute and say, what can we say about the yield under the street convention versus the true yield? Which is going to be higher? Well, if you get your payments later, typically the yield is lower. So the true yield is not going to be higher than the street convention yield, and in most cases, a little bit lower. Another yield for you, government equivalent yield. This is when we take a corporate bond yield and we restate it based on an actual year rather than basing it on a 3360 as we typically do for corporate bonds. So if we want to calculate the yield spread, that is the difference between a government bond yield and a corporate bond yield of the same maturity, well, in order to get a more theoretically correct spread, we need to calculate the yields on the corporate bonds and the government bonds in the same way. So, since the government bond yield curve, the benchmark yield curve, is based on actual, in order to get the government equivalent yield, we take the corporate bond and translate that from 3360 to actual. And that's the government equivalent yield, and that's why we want the government equivalent yield. So that'll make the spread between the government bond yield and the corporate bond yield. And that spread, we'll certainly talk more about it, but it's for default risk, credit risk. Corporate bonds have more credit risk, more default risk than government bonds in most instances that we'll run into. Okay. And so that's why we want them on the same basis. So we can say, well, here's the spread for this difference in credit risk. There may be a difference in liquidity, too, that also adds to that spread. We'll get more into that in other topic areas, but here, just why do we want to calculate this spread? And that's why we do and why we want to use that. Okay, we have bonds that are sometimes callable, right? They can say, well, after 5 years, the company can call this bond in at 101% of par value if they choose. Or after 10 years, they can call it in at par, 100% of face value. And as we talked before about it, that would be the first par call date, and the first date in 5 years is the first call date. Okay? And so we can calculate a different yield to call for each of the bond's call dates. What we're doing when we calculate the yield to call instead of the yield to maturity, it's the same thing, but we're going to change the payment stream and assume that the bond is called. So for each call date, we go, well, if you bought it today and the bond were called for its call price on this date 5 years from now, or at a different call price this date 7 years from now, then what would be your internal rate of return, your yield to maturity on this investment under those assumptions we had before, right? All the payments are made on time, bondholder holds it to maturity, and the interest earned on reinvested coupon payments is equal to the yield to maturity. So we're maintaining all of those, but now we're looking at yield to call. And the yield to worst is the lowest yield to maturity. So if you've calculated the yield to maturity, the yield to first call, the yield to first par call, or the yield to third call date if there is one, we'll calculate all these yields, and whichever one is the lowest, that's the yield to worst. And the reason bond buyers are looking at that is simply because what's the worst that can happen? What's the lowest, as long as it doesn't default, makes its payments on time, and I hold the bond and all this, what's the lowest return that I might earn on this bond investment? So that's the yield to worst. The option adjusted yield. Remember, we discussed before what including an embedded option in a bond does to the yield. A call option favors the issuer of the bond. They can call that bond in and redeem it early under the provisions of under the call provisions, if it's to their advantage to do so, and if it's not to their advantage to do so, they will not. So we said the yield on a callable bond has to be higher in order to compensate bond buyers for being basically short this call option that's held by the issuer. On the other hand, we said a put feature, an embedded put feature in a bond, is a plus for the bond buyer. So the yield will be less in the marketplace than an otherwise identical bond without a put feature. And we said the same thing about a conversion option to convert the bond into a fixed number of shares of the common stock of the issuer. So why do we want to calculate the option adjusted yield? Well, we want to compare bonds. Oftentimes in bonds, we're looking at bonds as similar ratings and seeing where we can get the highest yield without going outside that level of risk, that level of default risk, and matching up with the ratings we think we need on bonds in the portfolio. But if we compare an option-free bond to a bond with an embedded option, we're going to see that the nominal yield on that bond with the embedded option is higher than the option-free bond for reasons that we've just discussed. So how do we compare them to see which one might be the better value in the marketplace? Well, that's what this tool is for. The option-adjusted yield, we're going to take out the effect of the embedded option on yield and get an option-adjusted yield, and then we can compare that without worrying about the option because we've taken out that effect. So first we value the call option using derivatives option pricing model and some assumptions about expected yield volatility. That's complex. We're not going to get into it at level 1 other than to describe it like that. Now, then we add the call option value to the bond price. Why? Well, the bond price was trading at a higher yield. That is a lower price compared to an otherwise identical option-free bond. So we're going to say, well, the value of a bond with an embedded call option is the value of a straight bond, an option-free bond, minus the value of that call option. So by adding that back into the bond price, we're saying, well, here's the price it would trade at if it would be trading at currently if it didn't have this option. Now let's calculate the yield to maturity on that, and we will call that the option adjusted yield. For a puttable bond, its value is higher because it has a put feature, which is a benefit to the bond buyer, so they'll pay up for it, lower yield, slightly higher price. In that case, we value the put option using our complex option values and some assumptions about the interest rate paths over the life of the bond. And we calculate the value of that put option, and we have to subtract that from the volume. Then we do the yield to maturity using that price, and that's going to be our option adjusted yield. Let's talk more about floating rate notes. The coupon at the next reset date is the reference rate, right? Some sort of LIBOR or something like that, a market-determined rate, plus a quoted margin. That margin being to compensate for differences in credit quality. Remember, LIBOR credit quality is based on the credit quality of the multinational banks in London that are setting these rates for lending to each other. So, to the extent that a borrower that's issuing a floating rate note is of lower credit quality, we need to add something to that rate. If they're better credit quality than those money center banks, that quoted margin could even be negative. So that's why it says plus or minus a quoted margin. Typically it's plus, but I need you to understand that theoretically it could be minus if the credit quality of the issuer was better than the credit quality implicit in the reference rate. So required margin, on the other hand, is the margin that would cause the note's value to return to par at the reset date. Now, a little more about floating rate notes. say that our reset date is every 6 months. Every 6 months, we are going to change the coupon rate on this bond to equal 6-month LIBOR for the next 6 months plus a quoted margin. This quoted margin adjusts for differences in credit quality and liquidity. Now, if the credit quality stays the same, this quoted margin and this new interest rate every 6 months is going to be a market-determined rate, and it's going to return the bond's value to its par value. But it could be the case that over time this firm's credit quality got better since this floating rate note was issued, and the quoted margin is really more than is necessary given their credit quality and the liquidity of the issue. It could also be the case that it moved the other way, that their credit quality had deteriorated and the quoted margin is not adequate. Well, that's where we get into the required margin, is this discount margin. It would cause the note's value to return to par at the reset date. So if the required margin is greater than the quoted margin, the price can be below par. If the required margin is less than the quoted margin, the price can be above par value. Well, we bring this up because the idea of a floating rate note is by readjusting the coupon to the market interest rate at every reset date, that tends to return it to its par value. So you get variability in the interest you earn on a floating rate note, but not so much variability in its price. With a fixed rate note, we have predictable payments in the future. The coupon rate is set, but as market rates change, as we've seen, the value of the bond can move all over. You have price risk as interest rates change over time. So this illustrates that while we expect floating rate notes to return to their par values at the reset date, there are circumstances where it doesn't return exactly to the par value. And probably the biggest part of that is changes in the credit quality of the issuer, if it's changed in a significant manner since this floating rate note was issued and the quoted margin was established. And a little more on money market instruments. The yields are quoted as simple annual interest. Remember our money market yields. Maybe a discount yield or an add-on yield. We saw that with Euro commercial paper versus US commercial paper. May use a 360-day or 365-day year. So for test takers, this is great, right? When you can use one or the other and you can't pin it down, that's great. They can't ask you questions and say, well, what kind of year do you use with money market instruments? Well, they use 365 and they use 360, so no worries. If you want to compare money market instruments, use the bond equivalent yield, and that's on an add-on basis based on a 365-day year. Now, with all these different yield conventions and ways to calculate yields, that's when it gets troublesome, is when we want to compare yields and say, well, I can invest in this 2-year bond or I can invest in this 11-month money market instrument, but the yields are quoted on different bases. How am I going to compare those yields? Well, we put them on the same basis. We put them, and in this case, they're suggesting that we use the bond equivalent yield calculated as an add-on yield and using a 365-day year, and then we can compare them. And we'll treat the periodicity of yield on these money market instruments as 365 over the days to maturity. So if that's 180 days to maturity, that's about a semi-annual periodicity. But since these money market instruments can come with maturities in days, right? They're all less than a year. That's why they're money market instruments. So we'll get maturity in days, and so that's why we'll use 365 over the number of days to put these on an annual basis as well. So let's do an example with this bond equivalent yield. Calculate the bond equivalent yield, the BEY, for a $1,000 note with 219 days to maturity, an annualized discount of 2% based on a 360-day year. Well, we know about that. We need to unannualize that discount. And so let's do that. We've got it annualized. Remember, we annualized these money market discounts. We did it for T-bills. We multiplied the actual percentage discount times 360 over the number of days to maturity to annualize it. Here we're given that annualized discount, and we need to unannualize it, if you will. So we just multiply it over the number of days to maturity over 360 and find out the actual discount from a face value of $1,000 will be $12.17. So now we've got the discount. What are we going to do with that? Well, our current price we know now is $987.83 on $1,000 face value. So what is our holding period return? Our holding period return is just the discount over the price, discount over face value minus discount. That's our holding period return. We've got a 219-day holding period return. How are we going to get this on a bond equivalent basis? We're going to take that and multiply it with this simple annualization times 365 over 219 and come up with 2.05, slightly higher than the annualized discount because the discount wasn't really a yield. The discount is a discount from face value. Our yield is going to be a little higher than that. So that's how we would get the bond equivalent yield for this money market security, so we could compare it with the yields on other securities that either were already calculated as bond equivalent yields or turn them all into bond equivalent yields in order to do the comparison.